Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Getting Started with Options. And today, we're going to be talking about credit spreads, but I want to specifically focus on how vital the strike selection can be when trading credit spreads. We're going to be placing a bullish example trade today, but looking at it through two different lenses. We're going to look at two different traders who are going to take a very different approach to the same strategy. Should be a really interesting discussion. Before we get to that, though, let me first of all say hello to everybody who's already chatting in out there on YouTube. Hello, Prakash and John, Eva, China, Ricebird, Kevin, Will, Miralai, David, JD, Richard, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the recording, but be aware that you're invited to join us in these live streams if you'd like to be here. We'd love to have you as a live audience member. And this is a Tuesday webcast series. We kick things off promptly at noon Eastern time. It'd be great to have you here in the live audience. I also want to let my live audience members know that my longtime peer, Connie Hill, is going to be hanging out in the chat. She's going to be addressing any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Connie. And Connie and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters on X. It's really the very best place to connect with your favorite presenters when the cameras are off. So you can find Connie there on X at Connie Hill CS. You can find me there at Cameron May CS. But let's get into this discussion of the vital role that strike selection can play in the trading of credit spreads. All right, now as we do, of course, risk is real. We need to keep that in mind. So bear this important information, keep it top of mind. Equity and index options carry a high level of risk and are not suitable for all investors. This material is intended for general informational and educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and short options can be assigned at any time up to expiration, regardless of the in-the-money amount. All right, so with that said, let's set the agenda for what we're going to be discussing today. Today, it's all about strike selection when trading credit spreads. So I want to look at an example trade scenario where we have two very different chartists, two very different options traders looking at the same technical setup on a stock chart. And they're both going to apply a bull put spread, but they're going to apply it very differently. One is going to be looking for high probability in that trade. Other is going to be emphasizing the reward potential of the trade. And actually, the same strategy can be implemented by both traders. A lot of flexibility in this strategy just through different strike selections. So I'm going to lay out the pros and the cons of each approach. We're actually going to be planning and placing an example trade today on the Thinkorswim desktop trading software platform. So a lot to cover. Let's go right to the Thinkorswim desktop. And I'm going to be basing today's trade scenario just on recent price behavior on Apple. Let's say that we have two traders looking at the same chart, and they both notice this same recent price behavior and apparent what we might call a bull flag pattern on Apple, which is seen by some as a signal that the trend of Apple, in this case a bullish trend, seems to be likely to continue. This is traditionally a continuation pattern. So let's say that we have trader A and trader B. Trader A sees this bull flag or this bull pennant. I'm going to remove this now that we've seen it. So basically it's a rapid run up in a bullish stock, followed by a consolidation or price going sideways for a little while. Typically, that's just sort of seen as a resting point before possibly the bullishness continues. So let's say that trader A sees this pennant. Let me just clear the drawing set. And they think that this scenario is likely to happen. Well, they look over here to the left. They say, well, it's nice that we have this bull pennant, but maybe they have concern that there's this overhead resistance right here. They might think, all right, we have a bullish signal from most recent price activity, but maybe there's an obstacle still to be cleared. And they're concerned maybe the stock struggles to get much higher. Maybe still a bit of a bullish bias as they're looking out to, let's plan our trade for this October 17th expiration. So let's say overall their bias is still bullish, but they are cautiously bullish. They don't see this as an incredibly convincing bullish scenario, but enough to go ahead with a bullish trade. So they're going to tailor their credit spread very specifically to accommodate this outlook. Now, trader B has a very different outlook. So we'll call this trader A. We'll leave that one blue as the trader A assumption. Trader B sees this bull flag. They think, all right, so yeah, there's a little bit of resistance here. It's only one touch point, not a major obstacle. Maybe their conviction is that this flagpole is a good sign that we're about to blast off again. So let's duplicate this. Let's duplicate that drawing. Let's put it right there at a potential breakout point. And maybe they think that price is going to start rising rapidly. So I'm going to edit that. Let's make that our trader B signal. We'll turn that to red so we can see there's a distinction between these two outlooks. At the very least, maybe they think our stock is likely to head up to that level by expiration, using that flagpole as a guide. And that's kind of a typical application of a flag or a pennant pattern. So two very different outlooks on the same technical details on a stock chart. Is that a possibility? Can we have different convictions if we've all learned the same material? Yeah, actually, even though two traders may have the same technical background, they can still reach very different conclusions regarding what's happening on a chart. So we have trader A. They're going to be a little bit more conservative in the construction and therefore the strike selection on their credit spread that they're building. Trader B is going to be a little bit more aggressive, pursuing, they want to optimize this upside potential to a greater extent. And they're going to make different decisions. So let's go construct things through that trader A lens. So let's come over here, keep track of what we're doing. I'm going to use my scratch pad to explore the differences between these two approaches. So let's go to the 17th of October and set up trader A. Let's see. Let's make this bold so everybody can see it. So trader A has the outlook where they're maybe a little bit more conservative. Their preference is they're pursuing the probability of success. They're allowing for the fact the stock may not go straight up. There's a trade-off for that. Trader A is seeking probability. That's maybe their emphasis in the structuring of their trade. So let me ask those who are familiar with these strategies, if we want to structure a bullish credit spread, in other words, a bull put spread, how might the trader do that to allow for some flexibility, increase the probability of the trade? Well, with a credit spread, the objective ultimately is most commonly just to see those contracts expire worthless. And the out-of-the-money contracts inherently have a higher probability of expiring worthless than the in-the-money contracts. So we're going to go out of the money with this initial trade, and I'm even going to tie it to chart assumptions. Let's say that trader A thinks the price is at least likely to stay above 250, whereas trader B is convinced that price is going to break this resistance and we're going above 260. Those are different outlooks, right? So trader A, we're going to construct this to benefit even if the stock pulls back, but as long as it's above 250. Right now we're at about 255, right? So the way to structure this trade for higher probability, greater flexibility to the downside, this is all sounding like, ooh, awesome. Well, they're trade-offs, but we're going to go out of the money. So here's how we're going to structure this trade. We're going to stick with the 17th of October. And since this is a bullish trade scenario, a couple of basic approaches to trading bullishly. Number one would be buying calls. Number two would be selling puts, and then variations on those themes. All sorts of different strategies can be structured around those two basic premises. But we're going to be doing selling puts today. So let's say we sell the 17th of October. Let's do the 247.5. I'm going to keep these to $2.50 wide spreads. Sometimes you'll see me do $5 wide spreads. Sometimes you'll see me do $10. Let's do $2.50, and we'll just explore the pros and the cons and the reward and the risk scenarios of that. So we're going to sell the 17th of October 247.5 put. And that looks like that's trading around 208 to 212. Let's say we're able to get 210 for that. And at the same time, we're going to buy the, oh, you know what? Reverse this. Hold on. I'm getting a little bit ahead of myself. 250 put. Let's do 280 to 284. Let's say we're able to get 282 for that. Okay. Now we're going to buy the October, the one just below, 247.50. There we go. And that looks like that's going to cost us, yeah, in the neighborhood of maybe $2.10. Obviously, we don't know how much we're receiving or spending until those orders are filled. So this now constitutes Trader A's scenario. Okay. So how is this bullish? Well, when we sell a put, the objective is for the contract to expire worthless, or when we sell options, most commonly the objective is for the contracts to expire worthless. And as long as the stock is above 250, come that 17th of October expiration, these contracts will be in position to just expire worthless. Now, even an out-of-the-money contract can be assigned. That's still a possibility. It's just less likely, right? And look where the stock is right now. It's already at about 255. I'm rounding to 255 for convenience purposes, if you'll forgive me. But let's explore the potential benefit of doing this sort of trade, but also the potential risks. And then we can do a side-by-side comparison with another trade. Now, Paul says, is a delta 30 to 10 too wide? So Paul's looking at a different combination of strikes, maybe considering selling the 250 and possibly buying the 237.5 with that lower delta. Paul, too wide that's an absolute statement. There are actually pros and cons of widening a spread. It allows the trader to keep more of a credit, great, but it also exposes the trader to more downside risk, not so great. At the same time, more downside risk, not good, but the probability of actually incurring all of that risk also goes down. Well, that's a bit better. So there are pros and cons. So yeah, you've answered a good question. I'll maybe dedicate a different webcast to exploring like wider or narrower spreads. Today, we're just talking about in the money versus out of the money, if that'll work for us for today. All right, so what does the trader stand to make? What does the trader stand to lose in this scenario? What are the probabilities of either of those things playing out? What are the chances that we just break even on the trade? All of these are good questions for this. So let's look at the math. If we collect 282 for selling a 250 put, this is explicitly what's happening here. We're getting into a contract where someone else is conceptually paying this trader $282 for the right to sell shares to this trader for $250. If the shares collapse in value, they can offload it onto this trader, right? We might have to buy shares at 250. Someone else has the right to put those shares into our portfolio through a contractually enforced forced sale, basically. But that's it. So we're collecting $282. Nice, but we do have an obligation. Somebody might choose to sell shares to us for $250. This other contract where we're spending $210 gives us the right to offload those shares if we need to for $247.5. So if we get stuck with the shares at $250, we know we can sell those shares for $247.5. So it limits the downside exposure, at least conceptually. There are scenarios where that can change, but $2.50 is the theoretical maximum loss here. And we're net getting paid to do this. So it's not even $2.50 that's at risk. So how much is the maximum gain of this trade? Theoretical maximum gain. Well, if we're collecting $2.82, but we spent $210, that leaves us with a net credit of 72 cents. Doesn't sound like a lot, but also this trade isn't going to tie up a lot of money. That's how much we can make if these contracts just expire worthless. If this one expires worthless, we keep $2.82. If this one expires worthless, we lose $2.10. The net between those two outcomes is a 72-cent gain. not the max gain. I meant to say max gain, theoretical max gain. What is the maximum loss in this trade? Theoretical maximum loss happens here. Well, if the stock collapses, let's say, our stock up here at 255-ish, let's say it collapses down to 240. And this trader decides to sell us shares for 250. Well, we don't want them. They're only worth 240. So we sell those to someone else for 247.5 because we have the right to do that. That would be a $2.50 loss minus the 72 cents that was collected. We still have that in the account. So that would leave us with, what does that work out to be? $1.78? I'm doing that math in my head. Let me know if I blow it on any of this math, right? But yeah, just reversing this, 72 cents plus $1.78 is 250. That's right. Okay. So let's now just a little bit. This is a trade scenario where we stand to profit $72. If everything goes haywire, we stand to lose as a maximum $178. Yes, return on risk. Let's get our calculator here. If we have $72 that can be made and $178 that can be lost, that's a 40% return on risk. Right? But another way to just look at that is, Cameron, is this trader crazy? They're setting up a trade where if things work out optimally, they can only make 72 cents, but if it goes sour, they could lose up to $1.78 or $178. Yes. Yep. That's the scenario. Why would they ever go for this? Well, because there is a high probability of success and a low probability of failure, or if we define probability as maximum gain, or success as maximum gain and failure as maximum loss. Prakash says, in the future, how can we learn how to fix losing different vertical spreads? That's a good question, Prakash. I need to add that to my list. I have a little list of future webcast ideas because I want to address that. And the word, I'll address right now the word fix. We can't fix a broken trade. The markets can fix a broken trade. Traders can put on new trades and hope they go better. Unfortunately, what happens is that people that are trying to sell books or subscriptions or get people attracted to their YouTube channels, they make promises that are not accurate. And so they use phrases like fix or salvage or save or repair. Those sound awesome. None of them are actually terribly accurate, because really what we're talking about, what they're usually going to say with all these magical terms, is that when a trade starts to go sour, it's okay. We can fix, we can repair, we can salvage or save that trade by rolling. Rolling's not a magical ointment that's going to fix a trade. All it means is, all right, we're going to take our lumps on this trade, we're going to put a new trade on, and hope the second one goes better and makes up for the losses on the first. That's all that is. So yes, it's a good topic for a future webcast. Anyway, so a couple of other elements that we really need to understand in order to do a fair comparison between trader A's approach and trader B's approach, and for, let's say, trader C to decide, well, which one appeals most to me, we first of all need to look at some probabilities here. And one other number. Let's do the other number first. What about the odds of breaking even? Can you forgive me for abbreviating that to BE, break even? That's what that is. At what point, at what price at expiration would this trade be at break even? Well, we know that we can make 72 cents if our stock is above 250. This is a bullish vertical spread. And with bullish vertical spreads, we want to be above our strikes at expiration. So that would be above 250. So if we're not above 250, it must mean we're not making our maximum gain. So if we are 72 cents below 250, that's the break even. So we just take the upper strike subtract the maximum gain, and that gives us the break even. So that's going to be 249.28. Okay. So yeah, the final element here is now we know where we can break even on this trade, how much we can make, how much we can lose. Well, what's just the probability of these things playing out? And this is where our Greeks might come in handy. So as we're structuring this trade, we may want to have a column here. If we don't have this column, you can actually just click on the column heading and go down to Option Theoreticals in Greeks and choose Delta as one of the columns, right? But Delta has a couple of potential functions for a trader of options. Number one is it can tell the trader how much the option might make or lose as the stock goes up or down $1. So like this 250 put, if the stock goes up $1, it loses 32 cents in value. If it drops down $1, it loses, or pardon me, it makes 32 cents. So it shows us sort of a degree of leverage on the contract. But the other thing that Delta can do is tell us the probability that a contract will expire in the money. So if I look at my 250 strike, it has a delta of 32. That can be interpreted, translated to mean there's about a 32% probability that this contract will expire in the money. Well, with credit spreads, we want to expire out of the money. In other words, there is a 68% probability that our contracts that contract expires out of the money, and we have our maximum gain at expiration. If we just put this trade on, let it go. What's the probability of maximum loss? We can look at that strike. And here, if these contracts were to both expire in the money, maximum loss would be achieved. There's about a 26% chance of that happening. Let's call that a 26% probability. So this is now starting to give the, let's see, Andrew says, how is the probability calculated? So how is this delta achieved, Andrew? And so there are a few factors that go into this. Number one is, where is the strike price and how far is it from the current price? So right now we're $4.79. That plays a role, because even as the stock moves around, the likelihood that it's at least $4.79 lower at expiration, you can see that's probably less than 50%, right? Because it's already above that. We also look at the volatility of the stock. If a stock hardly ever moves, it's going to have a harder time getting down that low. And finally, we look at well, there are the three big variables, and the algorithms are going to be slightly more sophisticated than this, but distance from current price, volatility of the stock historically, and the time that the stock has to move to accomplish that move. So even if we have a stock that's relatively volatile historically, if there's hardly any time to move, it still is going to be a low probability of getting to that strike. So there we go. Those are sort of the three big variables. Good question. Hopefully that was helpful for you. That's not going to help. That's not going to allow you to now go out and calculate your own Greeks. It's a little bit heavier lifting than that. But what we do know about this trade scenario for trader A is it aligns with this outlook. If their emphasis, if their preference is probability, well, there's a 68% probability of this trade working out. The trade-off is that the reward for being correct isn't particularly strong, especially when compared to the other trade scenario that we're going to be exploring. All right. There's also a low probability of achieving this maximum loss. So for some traders, they'll say, all right, okay, so I'm willing to go for this. Got a high probability of success. I could lose more, but it's not likely that I will. And all the stock has to do for this to be the most likely outcome is for the stock to stay above 250 at expiration. Doesn't even need to stay there. Actually, if it just goes down below 250, as long as it comes back up above 250 by expiration, then we'd still be in position for maximum gain scenario. So that's trade A. Trader B is going to have quite the different outlook. Let's copy this. Let's paste this down here, and let's outline a different trade scenario. So now let's let me lean again on those who are familiar with credit spreads. If a trader wants to be a bit more aggressive, or maybe a lot more aggressive, what do they do with their strike selection? If they're pursuing higher reward, they might be looking at trader A and saying, Trader A, why are you settling for 72 cents? I'm going to set this up so I can make a lot more money if I'm right. We're going to go out of the money with this trade. So back here on our chart, let's say that our trader is at least convinced that we're going to be above 260. If you look at where we are right now, 255, proportionally, not a huge move required to get above 260. And we have 18 days to get there. Trader B might see this entirely differently. Let's be a little bit more aggressive. Come on, take the gloves off. So we're going to go to the 17th of October and plan a very different trade. Now, he was saying we could go way out of the money. Yep, I'm not going to be quite that aggressive, but the further out of the money, the higher the reward potential on these trades, but also the lower probability of actually accomplishing that potential. So let's for this trade, I'm going to go for, how about we do the 260 and 262.5 put spread. So here, what we're going to do, instead of selling the in the money contracts, we're going to sell, let's say, the 262.5 put and buy the 260 put. Now, this is going to require actually that we don't just get above 260. Maybe I'm kind of thinking I might want to go a different route with this. Yeah, let's be consistent with the scenario I set up on the chart. Let's say we sell the 260 and we buy the 257.5. That's fair for what I said, just needing to get above 260. All right. In any case, how much can we maybe get for this 260? That looks like that's trading between 760, 775. Let's say that we get 765. Ooh, wow, awesome. Great big credit. Don't get too excited yet, because in selling that put, we're going to buy the one just below to keep the spread consistent. That looks like that might cost us around 610. All right. So what do we see immediately? If we've collected 765 and we only spent 610, that changes this equation dramatically. 765 minus 610 leaves this trader with a net credit of $1.55. This has doubled the reward potential plus a little bit. Ooh, man, this is looking like a better trade already, isn't it? Pump the brakes on that thought. We need to discuss what better or worse means. But this is a trade with a 155. This is real-time information. This could conceivably actually be done right now. How much could the trader lose, though? Well, it's still a $2.50 wide spread. We've collected 155 instead of 72 cents. That's only going to leave 95 cents of reward potential, of risk potential. Look at side-by-side comparison. With trade A, that trader stood, for every dollar of reward, there was about $2.50 of risk. With this trade, with every dollar of reward, there's only about 65 cents of risk. There is a higher reward potential than risk. Okay. Now some traders might be getting excited. So what's the return on risk if the trade works out? We have 155 of reward potential divided by 95 cents of risk. That would be 163%. Wow, that's totally different, isn't it? Yep, it is. Now, before we start getting too excited, before we start drooling over this, we need to look at the probabilities of these scenarios and also the break-even point. Where is break-even here? With trade A, the trader just needed to be above 250. The in position for maximum theoretical gain at expiration. This is still a bull put spread. It's still a bullish spread. We still need to be above the spread at expiration to be in that theoretical maximum gain position. That's above 260. So the break-even point is higher. It's substantially higher. Above 260, we stand to make $1.55. So if we come up short of 260, that must mean we're coming up short of our maximum gain. So here's the math. 260 minus 155 is going to give us a break even of 258.45. Look at this. Now there's a little bit of a, oh yes, we are. Thank you, Eva. Assuming we're on Trader B. Good call out there. Yeah, let's make that change right there. So we have trade A, we have Trader A, Trader B, and this trader is emphasizing reward potential. Maybe they are convinced the stock is going to go up higher. They really want to pursue a greater reward if they get the anticipated move. They might be looking at Trader A and saying, you are selling yourself short here, buddy. If the stock takes off, you're going to get left in the dust. You're going to be holding on to your 72 cents while I'm dancing around the room with $1.55. Yeah. No, thank you for calling that out, Eva. Anyway, but we've seen the first little potential argument the other direction here. Trader A is feeling a little bit smug at this point. Hey, stock's already at 255. I only need it to be at 249.28 to break even on this trade. Anything above that, I'm making some money setting commissions out aside from the equation. You, talking smugly to Trader B, have to see this. The stock has to do some work. It needs to go up about another $4 just for you to have a shot at breaking even. So this is very different. Yep, that's one very different element between these two trades. Remember, we're using the same strategy. We've just changed the strike prices. Here's something else that's happened. This $1.55 potential reward can appear attractive, but what has to happen? Well, the stock needs to get above 260 by expiration. It may not do that. It may decide to go down. It could go sideways. It might go up, but not far enough. There are a lot of scenarios where the stock doesn't move high enough. So let's look at the probability that this 260 expires. 66% chance that this expires in the money. That's where it is right now. There's only a 34% probability that we get above that 260 and be in position for maximum gain. So yeah, much higher reward, but a lower probability of that reward being realized. Trader B might, somebody might say, well, then why in the world would they ever take this trade? Well, maybe they've done what they consider to be their homework on this chart, and they are convinced that we're about to make this nice pop upward. And really, there's 260. The math says there's only a 34% chance that we're up above that at expiration, because there's probably about a 50% chance that we're below that. There's probably about a 16% chance that we're between where we are right now and 260. So that leaves over about 34% chance that we're above 260 at expiration. But Trader B might just say, I don't care about those probabilities. I think it's going higher. Right? Now, looking at the opposite side of the risk-reward coin, if there's only a 34% chance that will be in that maximum gain scenario at expiration, what's the probability that we actually lose the 95 cents? Well, if we look at that, there's a 57% chance that contract is still in the money at expiration. And 57% chance or probability that we're at maximum loss. So that's probably, if we're just going to make a statement of what's probably going to happen, in this scenario, this is probably going to happen. With Trader B, this is probably going to happen. We're just going strictly with probability. So this now becomes a decision for the trader to make. If a trader really wants to optimize the probability of the trade, they just want to go for higher probability scenarios, allowing for some wiggle room to the downside, trader A may be making that choice. On the other hand, if the trader is quite convinced that the stock is going to defy the probabilities and race higher, and they want to optimize that upside potential, maybe they choose something that's more out of the money. Terry says, how about putting both trades on at the same time? Could a trader do that? They could. Just be aware that if there's any overlap of the strike prices, that could complicate the trade. Okay, in this case, there's not. These two strike prices are distinct, entirely separate from these two strike prices. But what could happen there is one could work out and the other one fails. And so maybe that mitigates the damage, but still net there's damage. Could also work out that both fail or that both succeed. If the stock just races up, this one works and this one works. So yeah, the trader might want to, if we're just acquainting ourselves with these strategies, maybe go place one of each in our paper money and see how they work. E. Dunny say, would that be an iron condor? Nope. An iron condor would be a bear call spread along with our bullish put spread. This is just two bullish put spreads. It would just literally be two bullish spreads. Yeah. Pathik says, what's the ideal time frame? I love that you ask these questions. What is best? What is ideal? What's recommended? We don't make recommendations. Best, it's going to vary, right? Just like there is no best between trade A and trade B, because there can be arguments for either one, and different traders are going to choose different ones for different reasons. As long as they understand the math, they can make that decision in an informed way. With time frame, that can vary as well. I think that most traders would say, hey, what I'd really love is 100% probability of success and a huge reward, and the time runs out in 2 minutes. That would be fantastic. Doesn't exist. So with these sorts of spreads, typically a trader is trying to balance the foreseeability of stock movement with enough reward to justify the trade. Okay. In other words, putting on a credit spread and leaving it on for a year, a lot of things can happen in a year, and the traders might struggle to try to anticipate where the stock is going to be. It can also really slow down the realization of gains. So too much time, for some traders, they might say that could be out, beyond about 50 days or so. If we go inside 20 days down to 10 days, 5 days, what happens with those is you have to put the credit spread, even for higher probability, put it so close to the current strike price that it can really elevate the risk of early assignment, things like that. So for some traders, they might look at like between 20 and 50 days as a potential sweet spot, but that's a broad statement. Doesn't apply to everybody. Okay. Yeah. Paul already says he prefers 21 to 14 days or 14 to 21 days. Yep. There can definitely be differences of opinion. All right. But how about which one should we do here? You look at this. Does it look more convincing that we're going to blast through that 260 level? In which case, maybe we go for that huge reward potential here. On the other hand, if we think that we might run into resistance, but at least stay above 250, maybe we go for this trade. Yep. You know what, Ted? Maybe you called me out on something. Yeah. Sometimes, no matter how long you've been doing this, in your enthusiasm to describe something and you're moving forward in what you're going to be saying, you can misspeak very easily. Yeah, which one of these is the out of the money? Which one is the in the money? This one's in the money currently. This one's out of the money. Yep. So if I blew that, my apologies. It can happen. All right. Looks like we have votes. Paul, John, Andrew, Lawrence all prefer trade A. Let's go do that. Let's go to the trade tab. A quick way to place this trade is come up here where it says spread single and change that to a vertical spread, and it just pairs up the strikes. So then we can go to the strike price that the strikes that we've been talking about, and just click on the bid price to create that vertical. Now, by default, that's going to load up 10 contracts. So if we're able to get, let's say, I'm going to back off of this. We originally thought we could get 72 cents. That looks like it's more like 70, maybe 69, maybe 68 cents. That's probably because the stock is going in the right direction. And so it's just offering a lower reward now for a higher probability trade. I think I'm going to back off on this. I'm going to go all the way down to, let's go down to the natural. I'm going to say we're going to accept even a 67-cent credit at this point. At 67 cents, that's going to leave about $1.33 for risk. No, $1.73 for risk. Anyway, good grief. I'm trying to hurry, and that's not a good thing. I can usually easily do this math in my head, but sometimes it's easiest to just recruit a calculator. 250 minus 67 cents is obviously $1.83. All right, but $1.83 of risk on 100 shares would be $183. Now the trader can just do the math and decide, well, can I afford risking $1,830? I'm actually going to do that. Let's do 10 contracts. Yeah, it looks like 67 cents is looking more achievable at the moment. I'm going to click confirm and send. And we're going to try to get 67 cents per share on 1,000 shares. That's $670 of reward potential with a high probability of success. But failure is also on the table. That would cost us $1,830 in loss. There are commissions to be paid on this trade, $13 total across those 10 contracts short, 10 contracts long. Let's click send. And all right, we're in at 71. Actually, look at that, 71 cents. We talked about 72 cents all the way through. So pretty close to the scenarios that we outlined. Guys, we've accomplished what I set out to do today. I wanted to talk about the vital role of strike selection when trading credit spreads and how just different strikes can lead to very different trades, even using the same strategy. So hopefully this was interesting and helpful to you. Let me open up that left column for just a moment longer so you can see that comparison one more time. You can see how probabilities, reward, risk, break-even points all change substantially with just different strike selections. This is what we do in these Tuesday webcasts in this series. So I hope you enjoyed that. Hope you'll join me again next Tuesday or just watch on the archives, which is great. But I have a couple of recommendations as I let you go to enjoy the rest of our educational offerings through today. First of all, make sure that you're taking advantage of all the resources made available to you by Schwab Education. First step would be, if you haven't subscribed to our Trader Talks channel, do that right now. It only takes a second, doesn't cost anything. Just go down there in that lower right-hand corner, click on the subscribe button, or go down below the video stream, click on subscribe. But our Trader Talks channel is where we house these videos after they're delivered. You can find the videos here under playlists organized by series. You can also join the live streams right here or do searches if you have a topic of specific interest. If you want to look through our video library, that can help you find things very quickly. Also, make sure that you're following Connie and me on X. If you have an account on X, you should be following your favorite presenters there. It really is the best place to connect with us in between these live streams. For example, I posted what I did over the weekend, and I've had a lot of people reply to that post and, tell me, wish me a great day, that sort of thing. That's great. We also have discussions about markets, charts, and all of that. So if you reply to one of my posts, I try to reply right back to you. But you can find Connie here on X at Connie Hill CS. You can find me on X at Cameron May CS. Love to have you there as follower. Thank you to everybody who's already clicked that like button. That's always appreciated. About 150 people watching live right now. 52 have already clicked the like button. That's like a pat on the back to your presenter, but it also gives their video a boost in the YouTube algorithm and helps more people find these webcasts and learn about the importance of strike selection. So will you like those photos? All right, let me Yep, there's the photo from this weekend's drive. But we also have things like discussing inflation, what's this candlestick pattern, things like that. Great resource there. Everybody, go enjoy the rest of your day. I will see you in a future webcast. I'll also look for you on X. Thanks, Connie, for helping out. Everyone, whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.